What are the best practices for minimizing gift and estate taxes for ag business operations? You're going to find out soon. Hi, I'm Norman A. Hood, financial advisor and host of the Exit Plan Show. I interview America's top advisors to help business owners enjoy more freedom, grow companies faster, and retire someday on their own terms. Today's guest is Daryl Dunneman. He's an agricultural financial consultant and accountant with Bonnet and Dunneman, LLC, certified public accountants and consultants. Bonnet and Dunneman serve clients in 18 states and have offices in Bushnell, Illinois and Havana, Illinois. Daryl's a 1975 graduate of the University of Illinois and a nationally recognized expert in the areas of agricultural financial analysis, business succession planning, and agricultural estate and income tax management. He's the editor of the Farm and Ranch Tax Letter, a monthly agricultural tax publication, and writes a regular tax management column for Farm Journal. Daryl's contributed to columns in practically every major farm publication in the United States and is a regular speaker at a number of national agricultural business education venues. 85% of Bonnet and Dunneman's business is in agriculture. Today we're going to talk about transfer tax best practices, Daryl, and we're going to talk about the rules of gift and estate taxes because I know they're changing all the time. A lot of farmers are probably up to date, but a year passes and there's been a few changes. Also going to talk about special use valuation, which is 2032A, and we're also going to talk about using the entity approach to reduce taxes. So let's take it away.
Thanks, Norm. Good to be here. Let's start out first with the rules. And the rules do change. We've got more stability, or theoretically have more stability, in the gift and estate tax system than we've had in a number of years. What we're approaching that now is more of a permanent solution. We had a few years ago a situation where we had increasing exemption amount that could escape estate taxation. And that was, we were afraid it was possibly going to go away at the end of 2012. Congress came back then and has extended it and actually given us some good little nuts for the future, meaning now a lot of these things that we looked at, a lot of the thresholds are indexed for inflation. So it means as inflation increases, exemptions will increase, and that's something we haven't had before. So let's talk then first about, for an individual passing away in the year 2014, what are those rules? First off, everybody has a level of assets. These are net assets, so it's assets less your liabilities. They also look at your last expenses of illness, the costs it takes to get the estate properly prepared, your funeral expenses, those type of things. And for 2014, the level is $5.240 million. And so that's a lot of money. It started at 5, it's increased by inflation, and it will continue to increase over the period of time. That means if you have net assets below that level, you're not going to owe any income tax. And if you do owe, estate tax, and if you do owe estate tax, it's going to be basically at the level of 40% today. Now, depending on where you are located in the United States, various states have then also estate taxes. For example, we're in Illinois. So Illinois has a different level, that's $4 million. So if you happen to be a resident of Illinois, then you would start at least Illinois estate tax at the $4 million level. And again, that's for a single individual. Now, if you happen to be married, you can get double that amount through. And one other thing that's came up here with this last law, and sometimes we don't know for sure whether our legislators know what they're doing, but they did give us something that was really kind of neat this last time, and it's something called portability. That means, for example, through titling issues, maybe I own $3 million of assets, and my wife owns $8 million of assets. So I haven't used my full exemption, and we can talk about a number of things, bypass trusts and things that would make for a better future program, but basically, I haven't used all my exemption. With portability, then what I don't use, and so for example, if I put all my assets into a bypass trust that my children would inherit after my wife passes away, then I haven't used $2 million. that $2 million can go over now to my wife's estate through an election, and we have to file an estate tax return, even if there's no tax that's due. And then she would have that, so now she's got above $7 million that she can use should something happen to her. So kind of neat. Now let's talk about gifting. Gifting, we can give away $14,000 to any individual we want to in 2014. That's increased from $10,000 when some of this started. Above $14,000 per individual, we have to file a gift tax return. Then people say, well, if I got to file a gift tax return, then I've got to pay gift tax, right? No, that's the other neat thing about our system is we have a combined gift and estate taxation system. So until I give away, if it was 2014, until I give away $5.24 million, then I don't have to pay gift tax. Now I have to file a gift tax return because then when I pass away, they're going to look at those assets that I still own in my own name or through an entity, and they're going to add back in the taxable gifts that I made. Again, that's going to be at the value that I gave them. So if we're talking about real estate, everybody's seen what's happened with real estate values over the past few years. Might have given that ground away when it was worth $3,000. Today then, when my family actually gets it, after I've given the gift, it might be worth 13 or 14. So we've escaped the gift or estate tax on that appreciation. So sometimes it's good to give away a taxable gift just to be able to stop the appreciation. Now, let's kind of look through then one other tool that's available, and it's not just available for farmers, but it's available for any family that owns a closely held business. And there's a number of criteria that we have to jump through the hoops, and it's called 2032A, or popularly known in layman's terms as special use valuation. Special use valuation allows property to be taxed for estate tax purposes at its productive value rather than its fair market value. So for example, some of these sales we've had in McDonough County, Illinois at $14,000. By using code section 2032A, we can lower that possibly as low as $5,000 an acre to get it through the estate. Now, the Lord giveth, the Lord taketh away. They put a cap. You can only lower your estate valuation as something like $1,090,000 for 2014. That's all that you can reduce your estate, and that then means basically half of your assets have to be closely held. At least 25% has to be real estate. You have to actively manage this property, basically paying Social Security tax or somebody or the entity actually operated it prior to your death. And then after your death, then a family member has to operate it for a specified period of time. It can really be neat if it can be used. But again, you have to meet the criteria. If I were just a landlord renting the ground out, I'm not going to be eligible for this because chances are I've not paid self-employment tax on this issue. So we want to take advantage of gifts. But wait a minute, it's pretty hard to go down and give away 2 acres of ground, isn't it? So what we often do, especially on the what we call the landlord side of the agreement, so the real estate, because if we talked in previous episodes, we like to see some type of a dual entity if the farm is going to go on in the future. The individuals who are going to be doing the actual farming own the operating assets, and then those who are going to be landlords are in a separate entity, and it might include your farming, individuals too. But basically then by having them divided up, we have 2 entities, we don't run into conflicts between the goals of the 2 parties. So that's where a limited liability company to own the real estate, or in some areas a family trust. We put that together for 2 reasons. Number one, it makes it very easy to gift away the percentage of the business. Instead of giving away 2 acres, we're giving away 0.5% or whatever the value is. And of course, we have to have those assets then valued. So if it's an entity, we have to have appraisals done. We have to have a valuation consultant who's qualified and understands discounts, because we can give away, for example, that $14,000 that we were talking about as a gift, and let's just say coincidentally that McDonough County farm ground is $14,000. You might think you could give away, 1 acre. However, through discounting, we may be able to give away 1.5 to 2 acres. because discounts they reflect the fact that who's going to buy this piece of dirt other than the people that are already in it? And then who's got control? So the same lack of marketability, the same lack of control we talked about in the previous episode comes to effect. So it makes us an entity, really makes it better to go ahead and give away a farm. And that's something that requires the use and the service of a good qualified accountant, a good qualified evaluation person, appraisers, and most of all, a competent attorney then to draw up these documents.
Okay, good stuff. If you want more information about Bonnet and Dunham, Darrell Services, please visit our website. Check out this episode. We'll have some text to give you a little more information. And then give them a call or visit their website. Thanks again for joining us.